Welcome back here with Money, 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 and this is the gold special on our festive series. So the question is, if you're actually looking at investing in gold, mind you, not just buying jewelry, but real investment in gold, then what are the best avenues? Should you be thinking of sovereign gold bonds? Should you be thinking of gold ETFs? Let's ask our experts. Now, Chirag, of course, you are closely associated with the functioning of an ETF. Yeah. So tell us, I mean, has the arrival of this new instrument, the sovereign gold bond, has it changed the market in any way?
Yeah, see, this year has been a very different year than usually we have. Demand has been significantly lower because of there were strikes by the jeweler community, there were real rates moving positive. So we are actually in a different ball game together.
But you're talking about the physical demand for gold.
Yeah. So overall demand for gold is same. Be it physical, only people choose different avenues to make their investment choices, and that is how it differs. Okay. So overall, it's guided by the overall demand for gold. So sovereign gold bond has been a new offering by government, and really it has seen good response, largely on account of the additional income that people can make on their gold investments. But there are certain drawbacks of that form of investment as well. One is it's not available on tap. Whenever I want, I cannot just go and buy. I can buy, but I have to go to the exchange, not to the government, not to the issuing entity. Yeah. And if you see on the exchange, there are liquidity issues. Okay. The bid-ask spreads are wide, liquidity is lower, and that can have investors step back from that form of buying. Okay, so let me also get in Harsh on this. So Harsh, on these two important aspects of ease of investing and liquidity, on-tap investing and liquidity, sovereign gold bonds sound phenomenal because over and above the capital appreciation that you might have, you also get an interest, right? The government of India is willing to pay you an interest. But what about the points that Chirag just raised, liquidity and investing whenever you want?
So like any other investment, there are four criteria, right? Risk, return, liquidity, and I would add a fourth in the context of India, ease of investment, right? Clearly return-wise gold bond scores. I mean, you get an interest instead of having to pay a fee to somebody. So I think clearly return-wise it scores. Risk remains the same. I mean, you're taking a risk. Okay, it's slightly different. In an ETF, you're taking a risk backed by physical gold that the fund house holds, whereas in a gold bond, you're taking a risk on the government of India's promise that they will match the price of gold.
But it's sovereign, right? So it's typically, sovereign, yes. Sovereign is almost considered risk-free.
Well, worldwide, as I'm sure Chirag will say, government promises are weighed just like anybody else's promises.
Yeah. We might not trust politicians, but when it comes to governments, we end up trusting governments a lot more.
And I think our government, as a government, has done enough. We have never defaulted. So I think sovereign, so risk-wise, there is very little to choose. That brings you to liquidity and ease of investment. Liquidity, clearly in an ETF, the liquidity is well defined. I mean, you go to the market, sell. You want to purchase, you go to the market, purchase. On a gold bond, you can on paper do the same. Right now the market is not that well developed.
Gold bonds have started trading very recently on the exchanges, right?
Absolutely.
So how is that working out?
So as he says, the liquidity may not be the best that you want, but I suspect that's a matter of time, which leaves us with ease of investment, I think. And I think on ease of investment, okay, again, there is another instrument that we have not considered, which is a gold fund.
Right.
And a gold fund in turn would invest in the ETF of its own fund house or maybe some other ETF.
Right.
In terms of ease of investment, gold fund is the best.
Why do you say that?
Because I can do a SIP. Now, very difficult to do a SIP in an ETF or a gold bond, though, is not available on tap, right? But in a gold fund, I can invest low amounts, okay? I can invest a fixed amount every month, right? So all that ease of investment actually is the best in gold fund, is the most expensive because there is a cost of gold fund, there is a cost of the ETF, and the interest element is very low because they are only allowed a certain portion.
So Chirag, explain the cost to us so that as investors one is aware of, what you need to obviously pay to the asset management company because they are obviously, providing you this service. So if you're talking about a gold fund or a gold ETF, what sort of cost should we be aware of?
See, gold ETFs are generally priced at expense of about 0.9 to 1% kind of range. So that is largely going towards storing, safekeeping, insurance of gold. Like for quantum gold fund, we also have terrorism insurance. So if anything goes in terms of a terrorist activity that happens and gold gets destroyed, it's still covered by the insurance.
Okay.
So that's kind of safety. We don't want to compromise even a bit on the safety aspect.
So 0.9 to 1% of your total investment
Yes.
would be going towards
Yes.
the fee.
Yeah, and I was sharing with him, as the size of the gold ETFs increases over time, these costs are bound to come down.
Okay.
So today you
How
might
does
be
it
paying.
compare with, let's say, the international benchmarks that we see? International gold ETFs that we talk about.
International gold ETFs are around 0.4%, but they
okay.
don't take insurance.
Okay. Okay.
So Indian gold ETFs take insurance, and like us, I don't know about the other guys, but we go a step forward and ensure that no compromises are made on the insurance that we have taken.
Okay.
Now coming to the gold funds that are there, which invest in the gold ETFs. So the gold funds pay an additional expense for managing that scheme. So it is over and above the gold ETF.
Because
But
they're investing in the ETF.
that costs are also coming down as the size of these funds, because nothing really happens in managing those funds. Whatever flows I get, I invest in that gold ETF
Right.
straight away.
Yeah.
No calls to be there.
Right.
So for that purpose, we charge a very nominal fee now at 0.1%. So all that you are paying additional is 0.1%.
Okay.
The
Okay.
advantage that you get there, when you buy as a retail person, your broker may charge an exorbitant brokerage, like about 0.5%. Whereas we as asset management companies pay about 12 bips. 12 basis points.
Okay.
So there's a vast difference between, though the 10 basis additional, but there's a vast difference when you invest.
Okay.
So that
Okay.
really saves you. So I agree with Harsh that gold funds are, I think, the best way, because one can do SIPs of like 500 rupees
Yeah.
a month. And
There's no minimum investable cap, or there's no minimum investment amount, which is the
It's
case
as
in
low as 500.
yeah,
as
which
low
is
as
which is the case in gold bonds, right? Because I think the minimum is 1 gram.
Minimum is 2
Okay.
grams. I think minimum is 2 grams. So
Okay,
you're talking
okay,
of
okay.
And the liquidity of those bonds can come into question, because each tranche of theirs is listed separately. So there has to be liquidity of each of the tranches in which you have invested, which is going to be
Are
very
the
cumbersome.
tranches not intertradable?
No.
That's a very important point then.
So right now liquidity clearly is challenged. It's a new instrument, but
Sure.
I suspect going forward,
As the
I mean,
market
give it
improves,
6
yeah.
months, 9 months.
Yeah.
I think that difference should vanish.
Okay.
Logically, that should not remain.
Okay, so let's take a break on that note. On the other side, this conversation continues. Which instrument should you invest in? Will taxation prove to be the real clincher? Which of these instruments is most tax efficient? Find out after the break. Welcome back here with the Gold Special, this festive series on Money, Money, Money. We've been discussing the best route via which you can invest in gold over and above all the festive jewelry that you'll buy this season. The question is, are sovereign gold bonds the better route, or should you stick with gold ETFs or perhaps gold funds? Well, we've discussed a whole host of different parameters. Now it's time to talk about tax. And here, Mr. Roongta, do sovereign gold bonds completely win hands down?
Oh, obviously, because I mean the appreciation is free as long as you give it back to the government.
Okay.
Okay. At worst, if you sell it, I mean, as long as you give it back to the issuer, there is no
So as long
capital.
as you stay invested for the entire period of the bond, which
Not
is 8 years.
necessarily. As long as you stay invested for the period, or you're allowed to give it to the government at the end of, I think, 5 years.
Okay.
Right.
Okay.
So at the end of 5 years, on every interest payment date, you're allowed to give it back to the government.
What
as
about the
lo-
interest that I'm earning on the gold bond? It's
I think it's
2.75%.
2.75%.
Is that also tax-free?
That is taxable. That is taxable.
Interest is
Interest
taxable.
is taxable.
Okay.
But the appreciation is not, as long as you give it back to the government. If you sell it in the market, however, it is taxable like an ETF. So if you have held it for 3 years, you would get the indexation benefit, and on the balance you would have to pay 20% tax.
Okay.
But that is same as, and if you have held it for less than 3 years, the entire gains are taxable. And we keep assuming, we keep saying gains. That's not always necessary that you will have gains. Remember, gold prices can be
Your principal
volatile.
is not
You could also
protected,
have
yeah.
losses.
Yeah. Okay. So, what are your views on taxation, Chirag? I mean, is taxation really skewing decisions in terms of investment, and is that putting ETFs at a disadvantage?
In a mathematical form, yes, of course, because given the sovereign power, they have made it tax-free. But if you see the ease of investing, I think it scores over and above the taxation purpose.
Okay.
And coming to the liquidity part that we were talking about, I think there can be challenges, though I think liquidity over a period of time can come, but there can be serious challenges to it.
Coming back to the point on taxation, so when we're talking about ETFs, if you're going to be selling or trading units in less than 3 years, then you'll have to pay short-term capital gains. So basically, it'll be at the rate in which you fall.
Marginal tax rate.
Okay,
yeah.
okay. And after 3 years, there's indexation benefit.
Benefit and long-term capital gains at 20%.
At 20%.
Yeah.
Okay. So that now brings us down to the final thoughts and questions on this. I know Chirag's favorite pick. I'm guessing it has to be gold ETFs. But what do you think? I mean, if you were to advise, looking at the current market situation, the evolution of the product as well, what do you think should one opt for?
So I would say for retail investors, and by retail I mean genuinely retail investors, gold fund remains, because he's not really worried about tax. Okay, I think there the ease of investment that a gold fund represents, and the best way to invest in gold like in equity is through systematic investment that only gold funds offer today. So for retail investors, I would say a gold fund continues, despite the costs, it continues to be top of my list. If you are a large investor, you have no real choice other than to go to gold fund, to gold bonds, to the extent you are allowed to. I mean, 500 grams per person per year.
And also keeping in mind that you might not have immediate liquidity. I mean, it's not a...
I don't think liquidity will remain a real problem. Okay. So I don't think, and for a large investor, I don't think that, because he can get a loan against it.
What about those who are looking at a short-term investment in gold and a long-term investment in gold? So then what instruments should they use?
Don't look at a short-term investment in gold, is my view.
Okay, Chirag, so final thoughts, and I'm now going to ask you to wear the magician's hat and get out the crystal ball and look forward in the future and give us some sense. It's been a great year for gold, at least the last 12 months. Will that continue?
Yeah, I think short term there could be challenges as the chatter for Fed interest rate hikes goes up for December. And election outcome is going to create uncertainty with the ebb and flow of news that will come. But overall, from a long-term perspective, what's going on, or the macro picture or a macro backdrop that we have, is extremely positive for gold. Given the central banks are hitting the wall, they don't have more options rather than continuing, either they continue the same policy making, which is erroneous in a way, it's not going to yield results, or something significant happens and that's going to create some sort of crisis for that to change. So in a way, it's going to be a win-win for gold over the medium to long term.
This short-term correction that we've seen last few weeks, is most of it over and done, you think, or will we see better levels, lower levels? And I'm saying because a lot of retail investors would be looking at buying these dips. So should they buy now, or do you think they'll get even better prices?
There could be some downside, but I think it's going to be limited, very, very limited downsides. I don't expect major downsides coming in gold. So any dip that you see could be an excellent opportunity, but don't try to time the market. It's better you get invested into gold and invest for the long term. That's what I can agree with Harsh here.
Okay, all right, Chirag and Mr. Roongta, thank you so much for your time. There you have it, all the details of how you need to invest in gold this Diwali. Hope this conversation has been helpful. Do send us your feedback, comments and queries. We'll see you again. The festive series continues on Money, Money, Money.